It's Brian Preston, the Money Guy.
All right, here's our first question. This question, Brian, is from Edward, and this one is so timely, and I think people will be interested in this one. Do the rising mortgage rates affect when prepaying debt falls on the FOO? For those of you that don't know, the FOO is the Financial Order of Operations. You can go learn all about our Financial Order of Operations at learn.moneyguy.com. And this is what Edward asks. At what approximate mortgage rate does it make sense to start prioritizing paying down your mortgage versus investing? Because we've been in this like really interesting low mortgage rate environment, Brian, for the last decade, right?
Yeah.
Well, now it seems mortgage rates are creeping a little bit higher. So does that change how we ought to think about mortgages, how we ought to think about debt prepayment, and even how we ought to think about the financial order of operations?
Yeah, this is a great question. And just to give context, because I think we've been somewhat spoiled here in the last few years, because, I mean, we've been putting mortgages, everybody's gotten so used to having 2.5%, 2 3/4, 3.25%. Those are the mortgage rates everybody has. And you're like, wow, this is great. Low interest rates. That's not the way it's always been. My first house, when I bought in the late 90s, had a mortgage rate of 6 3/4, and I thought I stole it. I mean, because I was so excited.
And right now, that just sounds crazy, right?
Well, because they were 7.5% just a few months earlier, but because they were starting to drop interest rates at the Federal Reserve, it created an opportunity as that started working its way through the market. So I was really excited. I think if you would have told me in the late 90s, hey, there's going to come a time in your life where you're going to have a mortgage on this beautiful house at 2.5%, I'm like, get out of here. That's crazy. So it is unique. But here's what I think you ought to think about this. Because when we did the financial order of operations, this is kind of built into the process too. And by the way, if you're brand new to the channel, go to moneyguy.com/resources. You can download the free deliverable of the 9 steps of the financial order of operations. Or if you want the deep dive to accelerate your success, go to learn.moneyguy.com. And we actually have a full course on the financial order of operations. But remember, step 3 of the financial order of operations is high interest debt. Well, you have to start asking yourself, okay, well, wait a minute. What qualifies as low interest debt? Because that's step 9. Step 9 is pay down your low interest debt. Step 3 is pay down your high interest debt. There needs to be some understanding of what triggers the differences there. And we actually covered this when we were designing the information for the financial order of operations. We actually talked about this when it came to student loans, because not all student loans were created the same. You found some people had student loans that were like 3.5%, depending upon when they graduated. And then other people had student loans that were getting close to 7%. So you have to say, well, hey, there's a difference there. So we want to give you the mathematical, because we're nerds. We thought about this in terms of risk-free rate of return. If you think about the spread between like what treasuries are getting and versus the risk premium you think you should receive for actually investing the money, because that's what, even though we all get used to markets making money, they definitely have volatility. We're going through a period of that right now where I think people are starting to go, wow, so this thing is a wealth creation machine, but it is that yo-yo part that Brian talks about where we throw the yo-yo up and down as we walk up the mountain. I'm feeling like that thing's dragging down a little bit. So it's important to pay attention to that spread, because you know that when you invest, the riskier the investment you make, the more premium you expect to be rewarded for taking that risk. So if you take into account this information, and there's one other variable I have to throw in, and I hate to be so complex with it, is taxes. Now, look, this is not as big of a deal as it used to be, because it used to be mortgage interest was probably your largest deduction on your itemized deductions. Now we've got much larger standard deductions that came into the tax policy in 2018.
That's right.
So it is one of those things where you need to figure out, is my interest rate lower than the stated amount because of a tax benefit? So figure out what your adjusted mortgage rate is after the tax benefits. And then once you know that amount, you can then compare it to the risk-free rate of return and your age, because that's a variable that should come in. And then you can say, okay, now I have some data points. I'm going to just give you an example. Now realize this is just an example, just to explain. I think somebody who's in their 20s, because you take the, where the risk-free rate plus the premium, that very well, especially as treasuries and stuff are getting to where they're earning like 3%, that risk-free, you know, that might be around a 7.5% to 8% before it gets classified as high interest. Now realize there's going to be a drop because the older you get, the more your risk profile, because it's not about just creating wealth, it's also keeping wealth. So there's going to be a difference between a 20-something versus a 50-something. Because I'm going to tell you, a 50-something, you're probably going to want to prioritize paying down that mortgage, even if it's as low as something in the 5%, 4 to 5% range, because you are in a different risk situation. But it's very much, like I said, we covered this in the actual course of the financial order of operations. It's learn.moneyguy.com, but we break out that calculation in much more detail of risk-free rate of return, your age, so you can kind of really streamline what you should be doing with your decision of what to do with your next dollar.
I love it. What I think is beautiful, Brian, is as the financial world changes, solid financial advice doesn't change, but how you apply it changes, right? So like right now we've been talking about, 30-year mortgages make a lot of sense because there's not a big difference in the rate on a 30-year versus a 15-year. If we get back into the area where rates are significantly higher and we're back at 5, 6, 7% mortgages on a 30-year, but 15-year mortgages might be lower, there's some consideration that needs to go in there, just like there's consideration with how you prepay it. The same advice applies, but as the world changes, we have to make sure that we're also making the best decisions given the present environment that we live in. I love that about financial planning. I love that about being a financial mutant. Financial mutant does not mean that I only believe one thing right now and that's the only thing I ever believe, because circumstances change and you have to be able to be malleable and understand how those changing circumstances can impact and change the plan that you have in place.
Well, also, you just said something that triggered in my mind. There's tools that we have not heard about in years because they just haven't been as important. Like think about variable mortgages.
Yeah.
ARMs, because I think rates have been so low. You're like, look, I'll do the 15-year, I'll do a 30-year, because why not? Rates are so low. I'm not really paying much for that benefit of locking it in and never adjusting. But when you start paying much higher mortgage rates, when you start paying the 6s and the 7%, and then you look out there and you see that you could do a 5-year variable at under 5%, you're going to be like, wait a minute. I might have to move in 3 years or 4 years anyway. Maybe that variable product is going to be better. Nobody's doing that while rates were dragging the bottom of the basement. But now that rates are going up higher, I think there's going to be other things. And look, there's going to be banks that will come on the scene that have liquidity and other things that they'll make those competitive markets. And that's why I do love that the system is always adjusting. And that's why I love that we can hopefully, help you guys. It doesn't matter how successful you are, because that's what I tell you. You can try to keep your life as simple as you want. Success will create complexity, and that's why there's always going to be an opportunity for financial planners to help out.